Imagine watching billions of dollars vanish, not because markets crashed, but because someone designed it to disappear. This isn't about clever scams or con artists. This is about engineered theft, orchestrated by people with access to global banks, governments, and the world's financial systems. Today, we're going to uncover financial fraud on a scale so massive that most investors still don't fully understand it, despite its impact being felt in every recession, every stock crash, and every ruined retirement portfolio. Welcome to the raw truth behind the greatest coordinated betrayals of trust in economic history. What you are about to hear is not conspiracy. It is documented fact, buried inside legal cases, whistleblower testimonies, and encrypted financial models. While the world watched companies and banks collapse on live television, the masterminds didn't just walk away. Some became richer. In this video, you will discover how fraud moved beyond traditional corruption into the realm of financial innovation, how the very tools invented to improve our markets were weaponized against us. You'll see how rating agencies, auditors, and even governments played silent roles. If this already shocks you, buckle up. What's coming next will completely change how you view the institutions you once trusted. Let's start with the name everyone knows, Bernie Madoff. His $65 billion Ponzi scheme is legendary, but what most people miss is how he did it. It wasn't just a simple lie. Madoff built a fortress of credibility. He was the former chairman of the Nasdaq Stock Exchange. His firm, Bernard L. Madoff Investment Securities, was one of the most respected market makers on Wall Street. He projected an image of exclusivity and stability. To get into his fund, you had to be invited. He promised steady, unspectacular returns, around 10 to 12% a year, every year. Not enough to raise red flags, but just enough to seem like a genius in any market condition. His secret wasn't a complex trading strategy. There was no trading. He simply deposited client money into a bank account and used new investments to pay off earlier investors who wanted to cash out. The paper statements he sent out, showing fake trades and consistent profits, were pure fiction. For decades, he defeated audits and fooled regulators from the SEC multiple times. Why? Because nobody wanted to believe that a man at the heart of the financial system was its biggest predator. Madoff leveraged our cognitive bias. We trust authority, we trust a proven track record, and we trust social proof. When everyone you know is getting rich with Bernie, you don't ask questions. The fraud only collapsed in 2008 when the financial crisis triggered a wave of withdrawals that Madoff couldn't pay. He confessed to his sons, and the largest Ponzi scheme in history came crashing down, wiping out fortunes, charities, and lives. The Madoff case taught us a painful lesson. Credibility can be manufactured. But what happens when the fraud isn't perpetrated by one man, but by an entire company, hailed as a technological pioneer? Let's fly to Germany and talk about Wirecard. For years, Wirecard was the darling of Europe's tech scene, a fintech giant poised to rival Silicon Valley. It processed payments for thousands of businesses worldwide. Its stock price soared, and it became a member of Germany's prestigious DAX 30 index. The company reported explosive growth year after year, driven by what it claimed was a booming Asian business. But a few journalists and short sellers began to notice something strange. The numbers didn't add up. They alleged that a huge portion of Wirecard's profits were fabricated. For years, their warnings were dismissed. The German financial regulator, BaFin, even went after the journalists, accusing them of market manipulation. Wirecard was a national champion, a symbol of German innovation. The establishment protected it. The fraud was deceptively simple. Wirecard claimed it held nearly $2 billion in cash in trustee accounts in the Philippines. This cash supposedly represented the profits from its Asian operations. But when auditors from KPMG were finally brought in to verify the accounts, they found a shocking truth. The bank statements were fake. The accounts never existed. The $2 billion, a quarter of the company's entire balance sheet, was a ghost. In June 2020, the truth came out. Wirecard admitted the money was gone, its CEO was arrested, and the company filed for insolvency, erasing over $20 billion in market value almost overnight. Wirecard shows us how financial innovation can be used as a smokescreen. The company's complex, opaque business model made it difficult for anyone to truly understand how it made money. They leveraged the narrative of a fast-growing tech company, and everyone, investors, regulators, and politicians, bought into the hype. They didn't want to believe that Germany's tech miracle was a house of cards. If you're still with me, comment below, Finance House Uncovered, to let the algorithm know this truth needs to be heard. Because the next fraud is even bigger, involving not just a company, but some of the world's largest banks manipulating the fundamental building block of our global financial system. I'm talking about the LIBOR scandal. LIBOR, the London Interbank Offered Rate, was once called the world's most important number. It was the average interest rate that major banks charged each other for short-term loans. But it was more than that. It was the benchmark for trillions of dollars in financial products worldwide, from student loans and mortgages to complex derivatives. Your car loan, your credit card interest, it was all tied to LIBOR. And for years, it was a lie. The rate wasn't calculated by a machine. It was based on submissions from the banks themselves. They were supposed to honestly report their borrowing costs. Instead, traders at banks like Barclays, UBS, and Deutsche Bank conspired with each other. They sent messages like, "If you know what I mean, nudge nudge," to request a higher or lower LIBOR submission. Why? For profit. If a trader had a huge position that would make money if interest rates went down, they would ask their colleagues to submit artificially low borrowing costs. They manipulated the rate, sometimes by just a fraction of a percentage point. But when you're dealing with trillions of dollars, that tiny fraction translates into billions in illegitimate profits. This was a strategic assault on the global financial system. It wasn't a glitch, it was a feature of their profit model. The scandal revealed a rotten culture at the heart of banking, where profit came before ethics, and collusion was just business as usual. Banks paid billions in fines, but the damage was done. The trust in the very foundation of finance was shattered. The LIBOR scandal proves that when institutions are supposed to regulate themselves, the temptation for systemic fraud can be overwhelming. Finally, let's look at a fraud so audacious it involved Hollywood movies, superyachts, and the looting of an entire nation's wealth. This is the story of 1MDB. The One Malaysia Development Berhad was a sovereign wealth fund, created by the Malaysian government to boost the country's economy through strategic investments. It was supposed to be a tool for national progress. Instead, it became a personal piggy bank for a corrupt few. At the center of it all was a charismatic financier named Joe Low. He had no official position at 1MDB, but he was the mastermind. Working with high-ranking officials, including the Malaysian Prime Minister himself, Low orchestrated a scheme to siphon billions of dollars out of the fund. The method was complex, involving shell companies, offshore accounts in Switzerland and Singapore, and layers of transactions designed to confuse and conceal. Money that was supposed to build infrastructure for the Malaysian people was instead used to buy luxury real estate in New York, priceless artwork by Monet and Picasso, a private jet, and even to finance the Hollywood blockbuster The Wolf of Wall Street. The irony is staggering. A film about financial fraud was funded with the proceeds of financial fraud. Goldman Sachs, one of the most powerful investment banks in the world, was deeply involved. The bank helped 1MDB raise over $6 billion through bond sales, earning an astonishing $600 million in fees. But regulators later found that the bank had ignored multiple red flags, turning a blind eye to the blatant corruption because the deal was too profitable to pass up. The 1MDB heist is the ultimate example of how global finance can be weaponized. It shows how sovereign wealth, the collective property of a nation's citizens, can be stolen in broad daylight with the help of the world's most respected financial institutions. So what's the pattern here? Madoff, Wirecard, LIBOR, 1MDB. These weren't just crimes of greed. They were crimes of strategy. The fraudsters understood psychology. They leveraged public confidence, regulatory weakness, and our collective fear of missing out. They struck when the system was vulnerable, dressing up their lies as innovation and progress. Many of these frauds began with the same intentions as legitimate financial products, which is why so many smart people missed them. They believed they were witnessing progress. The shocking truth is that these thieves wore suits, signed deals, and were celebrated as geniuses long before they were exposed. The next big fraud is already in motion somewhere in the world, using the same psychological tactics. But now, you know what to look for. You understand the playbook. This video wasn't just to inform you, it was to arm you. It's to transform how you invest, how you detect risk, and how you protect your wealth from the lies dressed as economic strategy. Think about the biggest financial frauds in history. Did they start with a villain in a dark room plotting to steal billions? No, they started with what sounded like a brilliant strategic opportunity. They were justified as temporary adjustments, clever market positioning, or even bold innovation. Today, we're not just talking about financial crime. We're dissecting the very machine that builds these colossal deceptions step by step. Because what history often forgets to teach you is that financial fraud isn't just about stealing money. It's about redesigning economic reality itself. Nearly every major financial fraud follows a chillingly predictable five-phase playbook. It starts with legitimization. Before you can deceive the world, you must first earn its trust. This is where the fraudster builds an aura of untouchable authority. Think about it. Bernie Madoff wasn't just some random fund manager. He was a former chairman of the Nasdaq. Wirecard, the German fintech giant, wasn't a fringe company. It was a star component of the DAX, Germany's most prestigious stock index. And the 1MDB scandal? It wasn't a back alley deal. It was a web that entangled Hollywood elites, global financial institutions, and even world leaders. The lesson is simple. For a lie to become massive, it must first be wrapped in the most convincing, legitimate-looking package possible. Credibility is the seed from which the grandest frauds grow. Once legitimacy is established, Phase 2 kicks in, rapid expansion. This is the growth phase, and it's always aggressive and intoxicating. You see hyperinflated revenue reports, valuations that seem to defy gravity, and a flurry of complex, cross-border deals that make the company look like an unstoppable global force. The media becomes a megaphone, celebrating the visionary CEO. Wall Street analysts upgrade their ratings, and small investors, fearing they'll miss out on the next big thing, pour in their life savings. They believe they've found the next Warren Buffett or the next Apple. This is the honeymoon period, where investor confidence is at its peak, and the fraud is disguised as genius. The company isn't just growing. It's a phenomenon, and everyone wants a piece of the action. Now we enter the most deceptive phase, illusion engineering. The meteoric growth from Phase 2 wasn't real, so now the architects of the fraud have to work overtime to maintain the fantasy. This is where the real dirty work happens. Numbers are creatively massaged, massive debts are hidden away in a maze of shell companies and offshore subsidiaries, and any losses are conveniently buried where no one will look. Regulators are either bribed, misled with a flood of jargon-filled reports, or simply outmaneuvered by the sheer complexity of the scheme. The most powerful tool in this phase is public trust. By now, the company is so beloved, so celebrated, that anyone who dares to question it is dismissed as a fool or a cynic. The public's belief becomes the fraud's strongest shield. But no illusion lasts forever. This brings us to Phase 4, collapse management. The end doesn't arrive with a bang. It starts with a whisper. Internal alarms start going off. A brave whistleblower might emerge, trying to warn the public, but they're often ignored or discredited. Auditors, staking their own reputations, begin refusing to sign off on the cooked books. Banks, sensing the rising risk, quietly start to reduce their exposure, cutting off the credit lines that kept the illusion afloat. Behind the closed doors of the boardroom, the confident smiles are replaced with sheer panic. The executives know the house of cards is about to fall, and their focus shifts from engineering the illusion to managing their own survival. And that leads to the final, cynical act, escape consolidation. This isn't a chaotic scramble, it's a pre-planned exit strategy. The money has already been moved to offshore trusts in non-cooperative jurisdictions. Contingency plans, drafted years in advance, are activated. Political connections that were nurtured during the legitimization phase are now called upon for protection. The company might declare a carefully structured bankruptcy, sacrificing certain parts of the empire to protect the core perpetrators. And in a final, audacious move, the mastermind often tries to flip the narrative. They don't admit to fraud. Instead, they blame the system, the market, or an unforeseeable economic downturn, painting themselves not as criminals, but as smart victims of a broken environment. The ship sinks, but the captain is already safe on a private island. So why does this matter to you, even if you've never invested a dollar? Because these frauds don't just vaporize investor money. They distort the entire global economy. Think about the LIBOR scandal, where bankers manipulated a key interest rate. This wasn't just a white-collar crime. It was a financial earthquake that affected an estimated $350 trillion in contracts worldwide. It changed the interest rates on your car loan, your mortgage, your student debt. When one MDB funneled billions through 9 different countries to buy yachts, private jets, and Picasso paintings, it wasn't just theft. It was the stolen future of an entire nation, Malaysia, which was told its sovereign wealth fund was profitable. When Enron used creative accounting to book profits they had never actually earned. Its collapse didn't just wipe out shareholders. It destroyed the retirement funds of thousands of its own employees and triggered a crisis of confidence in corporate America. And Wirecard, its executives literally forged bank confirmations to fake the existence of billions in cash. These aren't just isolated incidents. They are systemic shocks that redefine risk, reshape regulations, and erode trust in our financial systems for generations. And the danger is far from over. In fact, it's evolving. Today, the new frontiers for fraud are in emerging markets and new technologies. We're seeing the rise of AI-driven market prediction models that are so complex, they're practically unauditable. We have algorithmic fund management systems making billions of trades a second, creating opportunities to manipulate markets in ways we can't even detect yet. And cryptocurrency enables rapid, anonymous capital movements that make it easier than ever to launder money and hide assets from regulators. The fundamental playbook remains the same, but the tools are becoming infinitely more powerful and harder to trace. As we look toward the future, especially with predictions of market turbulence on the horizon, we need to be more vigilant than ever. History gives us the clues. Watch out for companies with overly aggressive growth narratives that seem too good to be true. Be skeptical of firms that lack transparency in their cash flow, even if their profits look amazing. Pay close attention to huge investment funds backed by opaque geopolitical interests, and be wary of dizzying capital movements facilitated by crypto. History has shown us, time and time again, that the next Madoff, the next Enron, the next Wirecard is not a question of if, but when. The foundations for the next great financial fraud are likely being laid right now, in the shadows, disguised as the next big thing. The real question is, will you have the wisdom to see it before the collapse? If this video has started to change the way you look at the financial world, let me know in the comments by typing, "I see through the system now." Subscribe to this channel for more deep dives into financial intelligence. Because here, we don't just study finance, we expose it. Thanks for watching.